Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time.
As promised, the feds are staying the course. Article from Forbes says what happened after the FOMC meetings Tuesday and Wednesday. The FOMC, which stands for the Federal Open Market Committee, announced another rate hike, raising the federal funds rate by 75 basis points to a range of 3.75% to a flat 4%. Follows a 75 basis point hike in June, July, and September, and two smaller rate hikes at the March and May meetings. All part of the central bank strategy to fight stubbornly high inflation. The FOMC will meet one more time in 2022 in mid-December. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and border price pressures. Read the FOMC statement. The ongoing war in Ukraine is a significant contributing factor to continued high inflation. The committee noted the latest Consumption Expenditures Price Index, the PCE, reports showed that prices across the economy have risen 6.2% over the prior 12 months. Fed economists estimated that PCE inflation will remain high according to the latest projections, but should decline to 5.4% by the end of 2022. Unfortunately, for stretched consumers, inflation can take a long time to return to normal, and it takes several months for the Fed's policy changes to work or even to be felt their way through the economy. However, it's worth noting that some financial effects of its policies, such as higher interest rates on borrowed money, can be felt more quickly. Let's see what happened today, guys, at the FOMC meeting and how the pros are reacting to this information from the Feds on interest rate hikes. Editor, roll clip, fair use.
All right, I think we just got the numbers. There we go, just in. So let's talk about how this rate increase will impact just our everyday lives. You just touched on it a little bit there, but, you know, credit card borrowers, new home buyers. I mean, we were just saying today when we were talking about the fact that this was going to happen, sure glad I'm not buying a home right now, but there are a lot of people in the middle of that, or they want to, or they need to.
Right, exactly, all of the above. And what this does is it just makes borrowing more expensive for consumers and also for businesses for things like credit cards, mortgages, home equity loans, small business loans, and car loans. The one, I guess, bright spot is if you're trying to look for higher yield on your money in the bank, some certificates of deposit and savings accounts are getting you a bit more for your money. They're not keeping pace with these interest rate hikes, I can tell you that much. But let's take a look at what this is going to mean if, for instance, you're trying to take out a mortgage. So if you had a $300,000 mortgage, at the beginning of this year, your payments on that mortgage have now more than doubled. You're now spending about $278 more a month on a $300,000 mortgage than you would have just 2 months ago. Taking a look at credit cards, this is a big one. Right now, the average rate on a credit card is over 22%. So if you are carrying a monthly balance, and Americans are carrying an average of $6,200 in debt, over the course of your loan, with today's interest rate increase, you're going to spend more than $360 a month, or over the life of the loan, I should say, to pay off that credit card balance. So I think that the short takeaway is try to pay off more than the minimum every month if you can, and get a handle on the debt, because interest rates are going to be higher for longer.
Economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
The senior economist. So, Sarah, obviously we're seeing increased market reaction here, but obviously we're still waiting for the exact wording to come from Fed Chair Jerome Powell. Just how tough is this balancing act going to be in terms of the wording of this?
Well, I think it's still going to be very tough because I think he's going to want to demonstrate that the committee is still very much committed to bringing inflation down, restoring inflation back towards its target, but also acknowledging the fact they've done a lot of tightening to date and it's time for things to slow, but they haven't given up on that inflation target. And so as some of the prior guests mentioned, I think it's going to be difficult to make sure that the market maybe doesn't run away with that somewhat more dovish message than the Fed has been signaling over the past few months, but balancing it with the fact that, yes, there's been a lot of tightening to date, but there's still a lot of work to do when it comes to inflation.
What's on your mind? Let's hear about, the title is What Does Carl Icahn Think of the Markets? And let's kick off with that right now.
Yeah, I think we have a real problem with the markets. I've been saying that, Steve, I've been saying that for about a couple of years now, in articles and whatever. I keep things pretty well hedged, but I have a very big hedge on now. I think we have a major problem, and I can go into it more if you want me to. I mean, why we do.
Yeah, please, of course. Give me a few bullets on what the specifics are that really get.
I mean, look. To begin with, we're trapped with this inflation. Inflation is a terrible thing. It's what brings down hegemonies. And you look at things simplistically. I look at it just very simplistically. That's where, if you can do that, and sort of understand the markets that way, you should be successful over a long period of time. And right now, there are real problems because inflation is a terrible thing. And once you have it, it's almost like being drug dependent, and it's very hard to get rid of it once it starts. I mean, I remember the 70s, but it takes out countries, it takes out hegemonies. And I think Powell is very right to do anything he can to stop this inflation that's coming on. And the real surprising thing is that you haven't had it before, because for the last years, we've been just printing up money and just giving it out. And one of the major problems is, I think, and nobody's blamed them, but it's corporate America. It's the CEOs, rubber stamp boards, and the money has been very cheap. So they've been able to borrow money very cheaply, but instead of putting it back into production, they've taken that money, borrowed more and more, and bought stocks at very high valuations. And now it's time to pay the price of that. So you'll have more and more debt coming due or interest rates to pay at higher prices. And that is a problem as far as earnings are concerned. And aside from that, household net worth, I would say median household net worth is really non-existent in this country. So half the households have no net worth. And the other half, except for the very top 10%, I think are very concerned about what's happening. And they're looking at their net worth, which is the market in their homes. And you have to be very concerned about that.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open. And OMG.
Oh my God!
To get more expensive, giving us opportunities in the future to prosper. Check this out. By not being over-leveraged, in bad consumer debts leaves us sane, prudent, and good Samaritans space for more liquid funds. And by doing that, gives us opportunities on the way. Guys, to he that much is given, much will be expected, guys. Jerome has actually stayed the course, although the way he is fighting inflation with these under the CPI numbers that won't do anything. At least he is doing what he said, and his actions are speaking super loud. To those who thought he would cave in and pivot, sorry, didn't happen. So guys, do your research and start getting out of debt. And hopefully start getting out of bad debt, because debt will continue to get more expensive, giving us opportunity in the future. Check this out. By not being over leveraged in bad consumer debt, leaves space for more liquid funds plus good credit. Amen to that, guys. Thank you for the support, and I'll continue to do my best to bring you the best. Let's keep moving forward, guys. Stay free.
It ain't hard to tell. I excel, then prevail.